Welcome to the Tax Lien and Deed Training Series. This is Lesson 3, brought to you by Tax Lien Investor Secrets.
So, the county needs a way of enforcing the property tax system. And the way they do that is through the tax lien and deed systems that are used in the United States. If the property owner doesn't pay his or her property taxes within a set time period, the county will issue a lien against that property. Now, the reason they're going to issue a lien against that property is because it creates an opportunity for them to recoup that money that so far they have not yet received. The way they recoup that investment is they will hold an annual sale. So they'll hold a sale once a year where they will sell these liens to public investors. Now, as an investor, the reason why the investor would be interested in purchasing one of these liens, and basically what a lien is for the amount of the delinquent taxes that the property owner owed, plus some penalties and fees that will be associated with that as well. So as an investor, you can actually purchase that tax lien, which will include that amount, and you'll purchase that because the state guarantees a set rate of return. So in other words, you're going to make a percentage on your investment, and that investment itself has been placed against the property itself. So that tax lien is placed against the property. What that means is that you're either going to receive that rate of return that you were guaranteed when you made that investment, or the lien itself will give you the right to actually initiate the foreclosure process against it. So a lien, by definition, is a claim against an item which affects the ability to transfer ownership by another party, which utilizes that item as security for repayment of a loan or other claim. The easiest way to look at a lien is to see it as being a claim against some type of a piece of property. They basically use that piece of property as collateral or security for the repayment of a loan or something else. We see liens about us every day. We just don't recognize them necessarily as liens. Things like a mortgage. A mortgage is a type of a lien. The bank itself actually owns the property until you have them completely paid off. So in other words, they actually hold the deed to your property until you have it paid off. Even automobile loans are a type of lien. If you don't continue to pay the regular monthly payments that are owed, if you don't go along with the stipulations of the contract that you signed, the bank or the lender can actually repossess the car as a result of it.
You know, Shade, one quick thing to add is that the counties, they really do need this money. I mean, we were researching in Florida this week, and we realized that just at this last tax sale in Miami County, what did they do? Over $200 million?
Yeah, it was $228 million is what they brought in through their tax lien sale.
And so you can see at $228 million, that would be a lot of money in county roads and utilities and buildings and all of the expenses that go to run a county. And so if suddenly a county doesn't have that $200 million, you can see even a big county like that could really suffer.
Yeah, absolutely. In fact, $200 million, no matter how you look at it, is enough to pay for a lot of services that counties provide. So let's play out a couple of scenarios here. As an investor, you show up at the auction, or you can be Investor Jack here. You show up at the auction and you purchase this tax lien. Again, this is an investment for you. You're interested in making either a high rate of return, or you're interested in acquiring the actual property. And let's play out what happens when that takes place. Once you purchase that tax lien, the property owner now has, in this case, it's 2 years, which is the redemption period, to pay back that delinquent amount to the county before that tax lien can actually give the investor the right to initiate the foreclosure process. So redemption periods are standard with all tax liens, and they range anywhere from 6 months on up to about 4 years is about the longest that we've seen. So that time period is basically a grace period for the property owner in which he can repay the county without any severe penalties such as losing his or her property. Now, does that mean that they don't pay some kind of a penalty or fee for being late? Absolutely not. It's impossible in this country to pay your taxes late and not have some type of a penalty or a fee associated with it. Now, to remove the lien, the property owner has to pay back all of the delinquent taxes that are owed, and the fees or the penalties that he or she is going to pay back is also going to include that rate of return that is owed to the investor. So really, the county's not dishing out any kind of money here. Really what the county's doing is the county is just simply the one that's changing hands here with money. They're accepting, or they're selling off the tax lien to recoup that lost revenue from the property owner's taxes that weren't paid. And once those taxes are received from the property owner, they simply their process is pretty simple from there. So let's say that the property owner pays the county all the delinquent taxes and fees that are owed. The county will simply cut a check to the investor for his initial investment plus the rate of return that he was guaranteed. So if this investor purchased the tax lien at an 18% rate of return, then he's essentially making about 1.5% per month because it's an 18% annual rate of return. So like I said, I think in most cases an 18% rate of return is excellent. The county will cut that check typically within 5 to 10 business days of receiving that money from the property owner. Now let's play out another scenario here. Let's say that the 2 years pass and the property owner still has not paid the delinquent taxes that are owed. If the property owner doesn't pay that amount within 2 years, then the tax lien itself actually gives the investor the ability to initiate the foreclosure process, which if the delinquent amount's not paid, can actually give our investor here the right to foreclose on the property and own it outright. So in other words, you could actually own the property free and clear of any other types of encumbrances just because of that tax lien that you purchased against it. So just for a tax lien that might be 1% of the property's value, 1.5% of the property's value, it could actually give you the right to foreclose on that property altogether. So really, in this situation, there are only two possible outcomes here. As the investor, you're either going to receive a high rate of return, or you're going to receive the actual property for your investment of the delinquent taxes and fees. That's what makes tax liens such a safe and such a secure investment. It's also what makes tax liens such a high-yielding investment. But those are really the only two outcomes that are possible here with tax liens, is either to make the rate of return or to acquire the property. Tax liens are one of the few investment strategies out there that really do create a winning situation for everyone that's involved. The property owner is given a grace period to repay his or her delinquent property taxes, which is a far cry from what a lot of European countries did at the time that this country was settled. In Europe, 250 years ago, if you were delinquent in paying your property taxes, chances are you wouldn't be a property owner very long. You'd probably be incarcerated. So this was, like I said, a far cry from what the forefathers of the country saw when they traveled to America originally. Now the county receives the delinquent property taxes that they need to continue to function, which is great for everyone involved. That means that the citizens of the county are able to continue to have those resources provided. And as the investor also wins in this situation because he's able to make a safe and secure investment and still make a great rate of return.